Chapter 3, Security Markets. So the security markets are broken down into two subsectors. You have the primary market, where new issues are created and sold. The issuer receives the net proceeds from the sale after they pay all the fees associated with the issuance. And in the secondary market, the owner sells to another party. The issuer does not take part in this, so as a result, they don't receive the proceeds from the sale. But the secondary market are probably just as important as the primary market, because the primary market couldn't function properly without the secondary market, because the buyers of those primary issues need to know that they can sell them if they need to in the future. We also have two different kinds of securities, privately held and publicly traded. Privately held ownership is held in a small group of investors, can be up to 2,000 shareholders. With regard to financial statements, the obligations are not near as onerous as those faced by publicly traded corporations, largely due to Sarbanes-Oxley. The primary offering of a privately held firm is sold directly to a small group of investors. Publicly traded, the securities are sold to the general public. Investors trade to trade shares. Shareholders, it's an unlimited number. The financial statements, as I mentioned, the requirements are much more onerous, largely due to Sarbanes-Oxley. The CFO, or the chief financial officer of a publicly traded corporation, has to certify to the accuracy of those financial statements. That was not the case prior to Sarbanes-Oxley. Primary often is sold to the public, most cases with an underwriter. And we'll talk more about underwriting as we move forward. Publicly traded companies, IPOs. IPO is an initial public offering. It's the first sale of stock by a formerly private company. There can only be one. A company can only have one initial public offering. After that, it's a secondary offering. The underwriters purchase the securities from the company and then resell them. This can take place in a couple of different manners. There can be what is called a firm commitment underwriting, where the underwriter guarantees the price of those securities, and there's also a best efforts, where the underwriter goes out and sells them as best they can. So obviously, with regard to the issuer, the issuer would probably prefer to have as much certainty. That each issuer has to decide which type of offering is best for their circumstances. When a company issues securities, it doesn't matter any kind of securities, they're going to prepare a prospectus. The prospectus is a description of the firm, the security being issued. Bonds have prospectuses, municipal bonds, corporate bonds. Their mortgage-backed securities will have a prospectus. Stocks, whether it be a common stock or a preferred stock, there would be a prospectus prepared along with those issuances as well. More on IPO. The issuer and the underwriter put on what's called a roadshow. The reason it was called a roadshow is because historically, the issuer and the underwriter traveled around the country making presentations to prospective investors. Much as much of this is done via video conference now, so there's not necessarily the need due to technology advancements and so forth. The issuer and underwriter can put on the roadshow basically via these video conferences and target their investors that way. Purpose of the roadshow is book building and to get ideas on pricing. So the book building refers to generating enough interest to sell the securities that the firm wants to sell and generate and ultimately generate the proceeds that the firm wants to realize from the sale. Underpricing is an issue, and it refers to the fact that typically the first month returns IPOs are generally very, very high. And we'll see in a minute or two that some countries the underpricing is incredibly high. It exists pretty much across the board. There are a lot of theories of underpricing. The underpricing is costly to the firm. The post-sale returns average 10% or even more. This is referred to with regard to underpricing as the winner's curse. What the winner's curse with regard to underpricing says is that you have to underprice. All investors don't have the information that they need to correctly value the security. So as a result, in order to pull the necessary investors into the initial public offering, you have to underprice the issue. Underwriting is typically set up as a group. You have a lead underwriter, or they're also referred to as the book runner or managing underwriter, and you'll have a series of other underwriters. In this chart we see there are 4, and then each of those are 4 below investment bankers A, B, C, D, and they're all selling to private investors. These are all together referred to as underwriting syndicate. If you see what's called a tombstone in the Wall Street Journal, it will typically list all the firms involved. The most important firm, or the book runner or lead underwriter, is typically at the top left, and the further down the page you go, the smaller the role that the underwriter is playing. Figure 3.2 shows average daily returns for European IPOs and non-European IPOs. We can look and see on the left-hand side there, the United States first day returns on U.S. IPOs are somewhere between 10 and 20%. Russia would be the lowest. Greece, on the other hand, first day returns around 50%. So some significant underpricing taking place in Greece. If we look at non-European IPOs, we can see that certainly China, over on the next to the far right-hand side, average first day returns 125%. Certainly underpricing is a significant issue there.